Well, U.S. President Donald Trump is calling on the Federal Reserve to cut interest rates.
But markets are betting against it as the Iran war sends oil and inflation pressures higher. Well, with crude oil prices surging again amid escalating conflict in West Asia, markets are bracing for rising inflation. The Iran-led chokehold on the Strait of Hormuz, which is a shipping lane that handles roughly 1/5 of the world's oil, has pushed U.S. crude to about $95 a barrel. Higher energy costs are expected to flow through to gasoline, food and transport prices as well, pressuring consumers and businesses alike.
Well, President Trump took to social media saying the Federal Reserve should be dropping interest rates immediately, aiming to support growth and borrowing costs.
But investors are moving in the opposite direction. Before the Iran conflict began, markets were pricing in 2 quarter-point rate cuts by year-end. Now they are barely pricing in one cut, if any, at all.
Well, part of that debate includes the Fed's leadership. Trump has selected former Fed Governor Kevin Warsh to succeed Jerome Powell as Fed chair this May. And Warsh is seen as more rate cut friendly. But even with a likely leadership change, inflationary pressures from rising energy costs are counteracting expectations of looser policy.
Now, one major Wall Street bank, Goldman Sachs, now forecasts that the U.S. personal consumption expenditures inflation rate rising to 2.9% by year-end. This is above the Fed's 2% target. They also delayed their predicted timing for a rate cut from June to September, reflecting the risk that inflation remains elevated for longer due to geopolitical disruptions.
While the ongoing tension has broader market effects, the bond markets have slashed rate cut expectations. The safe haven currencies like the U.S. dollar have strengthened, and stocks and risk assets remain volatile as traders reassess economic growth, inflation, and central bank response.